It's okay to hate economists sometimes. Just don't hate all economists all the time, right? There's this sentiment that like economists don't know anything about Bitcoin, and economists have never thought about competing monetary systems. And all right, like I'm an economist, Josh is an economist, Thomas is an economist, right? We think about these things quite a bit. We share those frustrations with other economists who don't think much about those things. It's not an empty set here. We think quite a bit about these ideas, and certainly in the history of economic thought, lots of other great economists have thought about competing currencies and alternative monetary systems. There is a lot to learn from those economists. So don't be dissuaded just because some economists say silly things.
Great. Thank you so much for joining me. I'm super excited to nerd out on this topic. So, thinking about credit and debt and the global economy and what that might look like on a Bitcoin standard. So, as I mentioned to some of you before in my discussions with other Bitcoiners, it always seems to come back to if we're on a Bitcoin standard, how would the global economy work when we're in such a debt and credit based system? Especially if there's an end to fiat, like what does that look like, and how do you think about that? So I'm really excited to dig into this topic with you guys today. But maybe before we get started, we want to go around and you guys can each introduce yourselves, perhaps in alphabetical order. So Josh, Thomas, Will, why don't we go ahead and start there?
Yeah, I'm Josh Hendrickson, so I'm the chair of the economics department at Ole Miss.
Hi, I'm Thomas Hogan. I'm a professor of economics at the brand new University of Austin.
I'm William Luther. Excuse me, I've already messed this up. I'm an associate professor of economics at Florida Atlantic University.
Excellent. And I'm Renee Swarchuk. I'm the VP of Research at the Bitcoin Policy Institute. And I also have terrible allergies, so you're not alone. I'm going to be sneezing as well. Okay, so maybe we can get started just by talking about some simple definitions. So maybe you guys can each describe what it means to you to be the world reserve currency. What does hyper Bitcoinization mean to you? And what would being on a Bitcoin standard mean to you? So maybe each of you want to dig into this a little bit.
Well, I guess I can start. I guess when I think about hyper Bitcoinization, there are two things that I like to clarify at the outset. The first is, what do we mean by hyper Bitcoinization? And you can really divide, if hyper Bitcoinization were to happen, you can divide it into two phases. The ultimate, we get there, hyper Bitcoinization, and then the transition to that, right? And so the point when you're there, right, most people are using a Bitcoin as money in much the same way that the dollar is the global reserve currency today. And so you can reasonably expect to go to most major cities around the world and be able to use dollars or conveniently exchange them for the domestic currency. But even in just saying that, right, it's an acknowledgement that even if hyper Bitcoinization were to be achieved, it doesn't imply that there will be no other monies. The dollar is the global reserve currency today, and yet a lot of people are using other monies. So even in that extreme hyper Bitcoinization world, it doesn't mean that no other monies are used. It's just that this is the dominant money. And that gets to my second point, I guess, which is we want to be very careful in talking about hyper Bitcoinization, not to commit what I like to refer to as the all or nothing fallacy. And this all or nothing fallacy takes lots of different forms. But in this context, the form that it often takes is that Bitcoin is either everything or it's nothing, right? Either it's the only money anyone will ever use in any transaction, or it's completely worthless. Nobody's going to use that. Like those are the two options, and you have to choose a side. That's kind of crazy, right? You know, we could have a very successful Bitcoin standard and still not be anywhere close to universal adoption or anything like that. I mean, the dollar is not there, right? And so we just want to be careful about that, right? We can consider what that very widespread acceptance would look like. But in doing so, I'm certainly not suggesting that anything short of that is a failure or that that is the most likely outcome or something like that.
Yeah, I kind of also think of it in sort of different phases, and you use these different terms about the Bitcoin becoming a widely held reserve currency by governments, and then hyper Bitcoinization, and then maybe something beyond that. I think one stage, like the first stage of governments holding Bitcoin as reserves, like kind of like Will said, that's already similar to what they're doing with the dollar, right? It doesn't mean all those countries are using dollars. It just means that they're holding it for some reason. For a lot of them, it's international trade, which probably, at least early on, wouldn't be as useful for Bitcoins. I think they'd be, holding them more for hopefully the number go up reasons or something else that they've don't want to miss the boat in case this becomes something really important. But we can have a lot of governments holding reserves without it really being much different in terms of the usage of Bitcoin as money. And then another stage might be kind of like Will said, that Bitcoin becomes more widely used, but isn't the dominant thing around the world, that you can go to a lot of different countries or areas and find other monies in the same way that right now the dollar, even though it's very dominant in international trade and usage in some places, clearly it's not used everywhere as money. And so I think going through those stages will probably take a long time before we get to something, if we ever get to something like, look, Bitcoin is used all over the world internationally as the main form of money. And so, so kind of like Will said, we may have transitions between these different periods. And we may want to talk about like what happens in the end state theoretically if we were using only Bitcoin, or if we were just in an area or a country that was using Bitcoin predominantly. Or even if we're just Bitcoiners holding Bitcoin ourselves in an area where other people aren't, all those things like would affect our own usage of money in Bitcoin in slightly different ways. And I think, maybe let Josh say something about this too, but I think it will be useful to talk about the characteristics of money in those different stages. So for example, once people are using Bitcoin as money, are they actually trading Bitcoins? Are they trading some other L2 that's built on top of Bitcoins, or another blockchain that's outside of Bitcoin but redeemable for Bitcoins, or bank issued money that's like, there's a lot of different possibilities for a state where we're using Bitcoin pretty widely, even if it's only held largely as reserves and not the dominant standard around the world.
Yeah, and also, what the return to Bitcoin looks like in those different transitions and end states, right? If during a transition, we should be expecting a very high return because you got a big increase in demand. But once you get to hyper Bitcoinization, you should expect a pretty modest return because you no longer have this huge increase in demand. You just have normal everyday old money demand growth there.
And I think the last thing to kind of distinguish between is like when we draw conclusions about like what a Bitcoin standard would look like. I think a lot of times when you say just the words Bitcoin standard, you're kind of drawing on like the gold standard, right? You're saying like this is a previous sort of monetary standard that we had, this existed, but that's also kind of very different than what these guys have been describing so far, right? So like one scenario is that Bitcoin is just like a competing currency, right? It just kind of exists alongside all of these other currencies. But there's also a scenario where it's completely different, where maybe some people start actually defining their currency in terms of Bitcoin, which is what, so the term dollar used to mean a particular quantity and quality of gold, right? Like that, the dollar was literally defined that way. And so that's another question. So if we end up in a hyper Bitcoinized world, does that look like the current world with just like a more prominent role for Bitcoin, or does that look like a gold standard world where you actually have a lot of different names for currencies, but they're all kind of redeemable or defined in terms of Bitcoin or something like that. And so in that sort of a world, you'd have like a lot of similarities with like the previous sort of gold standard era. But but if that's not the case, then you're going to have much more similarities with kind of like the current era that we're in, where Bitcoin is just a much bigger competitor.
Well, maybe you can unpack that a little bit, because you had mentioned before that you think some things would change and some things would not. And there's certain aspects of the economy that are unique and not unique to the system. So do you maybe want to elaborate on that a little bit?
Well, I guess there's a couple of things. So if you, if you just
To
think
put you on
about,
the spot.
yeah,
Sorry.
I mean, if you, I mean, there's a couple of issues here. I mean, if people are defining their their currency in terms of Bitcoin, then like the supply and demand for Bitcoin is going to be what determines how the price level is moving, right? So what that means is like if the dollar is defined as a particular quantity of Bitcoin, then the prices of everything are going to be determined by the supply and demand for Bitcoin itself, right? Which is how it worked under the gold standard. So when when the dollar was defined as a particular quantity of gold, it was the supply and demand for gold that was causing prices to change over time. On the other hand, if you have Bitcoin as just this separate thing from the dollar, one role for Bitcoin might be as a sort of hedge against whatever your domestic currency is, right? Because since Bitcoin is set up to have a fixed supply, and our sort of sovereign currencies have this inflationary bias, maybe people are holding Bitcoin as a sort of hedge against that inflationary bias of their domestic currency. But so if you yourself are living on a Bitcoin standard where you don't have any dollars, then as far as you're concerned, everything is priced in terms of Bitcoin. But when you go to the store, the shelves would probably still have dollars, for prices, and and those prices would be fluctuating with the supply and demand for dollars. And so Bitcoin's purchasing power would differ, and it would be very similar to today. It's just that people would be using Bitcoin more often.
Yeah, I guess to follow up on that, in terms of like things that would be different and things would be the same. I think there's this tendency that's not unique to Bitcoiners, right? But when there's something that we like, we want that thing to be associated with all of the good things and none of the bad things. So, someone might think that we have too much debt in the world today. And so that will lead them to believe that, well, if we just didn't have fiat money, we would have less debt, maybe no debt at all, right? Or sometimes this can even get into the realm of nonsense, where I like going to the opera, and so if we could just get rid of fiat money, then everyone would enjoy the opera or Greek poetry or whatever your flavor is, right? And the thing that we should recognize is that most of this has absolutely nothing or very little to do with the monies that we're using. People's decisions to, patron the arts or to engage in lending, they're doing those things because they find those things valuable to do, and in the case of the arts, maybe the money that we're using has nothing to do with that. In the case of the finance, there could be some interactions there, but we should not have this inclination to think that everything depends almost exclusively on the monies that we're using, right? That decision to use monies is just one decision in a big portfolio of decisions that we make, and those relationships may be very, very minor and likely are in most cases.
Yeah, can I?
Yeah, go ahead.
Can I say something? So, kind of relating a couple of the points that Josh and Will made. So, this is why I mentioned. So, let's say we're on a Bitcoin standard, and we may have like L2s, or we may have banks, or we may have, like as Josh mentioned, countries that make their dollars or whatever currency redeemable for Bitcoin. Right? In those cases, you have a couple of changes. One is, like Josh said, the base money of Bitcoin is kind of similar to a gold standard, except that it's not responsive. And so we could talk about that as one part. But the separate thing is, traditionally on the gold standard, you had banks issuing banknotes, and you had this financial system and credit system. And in most of those systems, that's not going to change. If we have banks that are using Bitcoins as reserves, if have countries that are making their currency redeemable for Bitcoin, they're still going to have credit markets, right? If we have L2s, we may have DeFi on Bitcoin. And so, all those things are kind of going to continue in a similar way. They will affect the issues of the amount of base money. If we're using base money, if we're using Bitcoin as base money rather than like gold on the gold standard, then that's going to be a little bit constraining. But you still have these credit markets that are also going to be adjusting around that. And so I think a lot of that stuff would still exist, and could be pretty similar to what we have now.
So maybe going into the debt and credit aspect a little bit more. I like what you said about there's Bitcoin, but then there might also be these like e-tokens or there's L2s on top of it, right? So maybe we could talk about, I know that you also said you don't think that it's a binary, Bitcoin succeeds and it's everything or it's nothing. But maybe we can theorize a little bit here. So let's say that the world, everyone is using Bitcoin. It's a widely accepted medium of exchange. Everybody wants Bitcoin. Fiat is almost gone. I mean, if you can't accept that, maybe you can like work into your, model however you would like.
We're economists. We love simple models. So we have a world where everyone is using Bitcoin and no one is using anything else.
Okay, so let's go with that scenario. Maybe we can have 3 scenarios if we need to. But let's start with that scenario. So everyone is on using Bitcoin. There's no fiat. So how would debt and credit work given that Bitcoin is a deflationary currency? So thinking about, there's different kinds of borrowers. There's corporations or companies that maybe you could provide some equity in, but then there's individuals. So I'm thinking about a plumber who needs to buy a new truck, right? Or maybe a teacher who wants to buy her first house. And so no one is going to loan these people Bitcoin without some interest because it's a deflationary asset. It'll be worth more over time. So they not only have to pay back the Bitcoin, which will go up in value over time, but they have to come up with this interest. And that might be really challenging, especially if your salary, if it's a deflationary asset, does it stay the same? Does your salary possibly even go down in the number of Bitcoin you receive? So how would the debt and credit system work if we were solely using Bitcoin?
I think there's 2 separate issues here. So what I hear a lot is Bitcoiners will say things like, well, an inflationary system like incentivizes like more borrowing behavior and things like that. There's a sense in which this is right, but there's also a sense in which I think this is somewhat misleading. So the sense in which it is right is that higher inflation tends to push people away from money and into higher yielding assets. Okay, and in particular, real assets, right? So assets that people expect are going to retain their value. So when that happens, like a prime example would be something like housing, right? So like as inflation rises, like people are likely to store more of their wealth in housing than if they were in a world with no inflation. Just because the house is likely to retain its value, you can live in the house, right? Like buying more housing doesn't necessarily mean like you wouldn't buy a house, but now you buy a house. Maybe it's just that like your house has like an extra room or 2 in it, right, relative to what it would have been otherwise. And so to the extent that you have to borrow to finance those kinds of purchases, like yes, that does kind of like increase your borrowing. But I think also when we're talking about borrowing and lending, what we really have to focus on is the real interest rate, right? So when we're thinking about the real interest rate, what we're thinking about is like if I'm a borrower, I'm thinking about, okay, what do I have to give up in terms of future purchasing power to pay for this thing? Whereas if I'm a lender, what I care about is that repayment in terms of the additional purchasing power that I'm going to receive. So for example, if the nominal interest rate is 10%, but inflation is 10%, if I'm lending to somebody at 10% and everything is 10% more expensive, then I'm not getting any actual benefit there, right? And so what really matters is the real interest rate. And so if you switch from an inflationary currency to a deflationary currency, you know, all else equal, okay, which is a huge another of our favorite huge assumptions, right? Is that like what we would expect is that this would affect nominal interest rates, right? So like the real interest rate might stay the same, but the nominal interest rate is likely to change, right? So the nominal interest rate right now is taking into account the real interest rate plus people's expectations of inflation. And so I would expect it to have much more of an effect on the nominal rate than any real rate. Now, to get back to my original point, that doesn't mean that there would be no effect on the real interest rate, right? So, in other words, if people are moving towards more and more real assets because of inflation, this can actually drive down real interest rates as people move into those other assets. And so it's possible that in switching to a deflationary currency, that real interest rate would also rise a little bit and deter some level of borrowing. So I think that it's probably true that there would be less borrowing, but at the same time, what really matters is the real interest rate, which means that like there wouldn't be no borrowing. It's just that the terms would be very different and the expectations would be very different.
Yeah. Can I follow up on that? I mean, I would say a very, very similar response to that. So I think exactly what Josh is saying. The first point being, look, we think about real interest rates. So if you're, we borrow in nominal interest rates. So if the real interest rate in the economy is about 3% and people expect 2% inflation, then the interest rate you get from the bank is going to be about 5%. But if instead of 2% inflation, they expect 2% deflation, then it'll be the real interest rate of 3% minus the 2% means you get an interest rate of 1%, right? And so the interest rate is going to adjust to account for what people think are going to happen with prices. And so even in a deflationary scenario, you don't necessarily have a lack of lending. You may have a little less, like Josh said, but you still have some of that. What you have instead is people save a little bit more before they buy so that they don't have to borrow as much, right? A large portion of that, because they're getting a better return on their savings then, is going to be a bigger down payment. And we see this in periods of U.S. history. Like if we look back to the gold standard, basically we had two big wars, the War of 1812 and then the Civil War, where the U.S. government went off the gold standard for a little while so it could spend more money. And in both of those wars, the price level roughly doubled. But then after the next decade or two, the price level was slowly coming down to what it had previously been. And so we have, several decades of deflation where the economy didn't stop and people didn't stop borrowing. They changed their incentives a little bit and it affected interest rates. But yeah, it just means, people are going to save a little bit more and make a bigger down payment on their house or their car. But they're still going to be able to borrow. It might just, shift the types of activities that are happening. Adjustments between savings and borrowing affect which types of businesses are easy to do. If it's borrowing, I think there will be some effect on the sectors there. But it's also one other thing that I wanted to mention is it's not obvious that you would have a deflationary environment on a Bitcoin standard. Because like I said, you have the base money of Bitcoin, just like on the gold standard, the gold was the amount of base money, but the gold standard adjusted and you could supply more gold where you can't supply more Bitcoins, right? Everybody knows that. That's an important aspect. But as long as you have these credit systems on top of it, you can have credit that's growing. And that might be through fractional reserve, or it might be through collateralized lending. Like if you go to Aave or if you mint DAI tokens, those things are all collateralized loans that can expand basically the money supply without issuing new Bitcoin. And so as long as we think that we're going to have some kind of L2, we're going to have some kind of credit system through banks, or again, if countries denominate their currencies in terms of Bitcoin, they'll still probably have credit systems. So it's not obvious that I think it's probably likely that we'll have some deflation, but it's not clear that that'll be a big deal because you'll have these credit mechanisms that will minimize that impact, right? And so, we're not sure what the overall outcome would be.
Yeah, I think that Josh really set us on the right track here. I think in terms of starting with as a first approximation that there's no change in the real interest rate, and then considering the marginal effects based on the uniqueness of Bitcoin relative to other base monies. And so let me try to explain why I think that's a good approach, right? The reason as a first approximation we want to assume that the real interest rate isn't going to change is because we're looking at transactions that people want to make. Right? If you have some productive investment, right, you want to take on that project, and other people are going to be willing to lend you money in order to take on that productive project because it's a productive project, right? If you have some future income that's much higher than your current income, right, in real terms, and you want to smooth out your consumption, right? Other people are going to be willing to lend you money so long as they are reasonably confident that your future income is much higher, because they're going to be able to make a return on that. And you want to engage in that lending because it enables you to smooth out your consumption. And so when we're thinking about those credit relationships, those lending relationships, we're primarily talking about things that people want to do on both sides of the market. And typically, if there's something that people want to do, they're going to work really hard to find ways of doing that. Now, our particular monetary or financial regime might encourage or discourage some of those transactions on the margin, but by and large, people still want to do those things, and they're still mostly going to be able to figure out how to do those things. In terms of the marginal effects, I think that Josh is probably right that it would decrease borrowing a bit, but there are some offsetting channels here that we should consider as well. So, for example, one of the problems with our current fiat monetary system is that it makes it very difficult to predict the purchasing power of money in the future. We don't know exactly how the Fed's going to conduct monetary policy. So maybe we end up with a lot of inflation or a little inflation or some deflation. And what this means is that we don't know what the value of the dollar is going to be with any real degree of certainty well into the future. And correspondingly, long-term contracting is riskier than it otherwise would be. And that includes long-term contracting in lending. And so loans on a fiat system are riskier than they might otherwise be because of that uncertainty. And so if you're able to reduce that uncertainty by having a very predictable supply, and if demand has an easy to predict growth over time, then that might reduce the uncertainty associated with long-term contracting and result in more lending because it would make lending less risky. So again, as a first approximation, I think we want to start with this assumption that real interest rates are largely unchanged, and then think about ways in which we might have some marginal effects that discourage some lending or encourage some lending, and figure out how those things wash out.
Okay. So maybe expanding on that a little bit, Josh, you mentioned that there is a possibility that people need a bit larger down payments, maybe lending goes down a little bit. So if there is slightly less lending, even if it's a small percentage, I imagine that would have some impact on kind of the global economy that so much is based on debt and credit. So do you have any thoughts on how this might impact the economy as a whole globally?
Well, so I mean, I guess it really depends on like what borrowing and lending is taking place, and sort of um, and this kind of gets us into, I think, like perhaps like some more controversial claims, right? So, I mean, when we think about business cycles, like the Austrian theory of the business cycle is entirely predicated on things like malinvestment, right? And so if that's sort of the type of borrowing that's not taking place anymore, are like these projects that aren't going to pan out, then that's like a net benefit to society, right? Um, on the other hand, if it becomes harder to finance productive investments, then maybe you're missing out on something that would be potentially productive. But I think like I'm not wholly worried about that, because if you have a productive investment, and if you can kind of, if you have some evidence, that it's going to be productive, people are going to be willing to lend to you, as long as you can agree to terms on those, because effectively, like you're just trying, as a lender, you're just trying to capture some of that return, no different than if you were a shareholder, right? Like that's what you're trying to accomplish with this loan. And so to the extent that you have productive things going on, I don't think that it necessarily matters. But also, I mean, like lurking in the background is kind of this idea of, well, is our current level of debt optimal? So if we start from the position of, well, debt's going to go down, isn't that bad for the economy? Well, that sort of suggests that we currently have the optimal level of debt. And so any reduction in that would make things worse. And I think that's a really, really hard question to address. And I think, but I think that is sort of implicit in these kinds of arguments of, well, is this going to be good for the economy or bad for the economy? It depends on how close we are to optimal now. Now, clearly, Bitcoiners think we're very far away from optimal, and I don't think they're alone in that. I mean, I think if you just look at popular sentiment, there's a lot of complaints about about the size of government debt. There's a lot of complaints about the size of consumer debt. Like you've seen people arguing, for example, that maybe we need to bring back usury laws and things like that. And like those things, like, I mean, the net effect of those things would be to reduce lending. And so if so it's possible that reducing the debt isn't actually all of that significant. Some of this debt might actually not be serving like a societally beneficial purpose.
Yeah,
I
and
think a lot of people would
we've
agree with you.
primarily been talking about the amount of debt, right? But it would also be useful to recognize that there's a composition issue here as well. So it could be that we make some transition to a new monetary regime, and that increases the total amount of debt while reducing the bad kind of debt that we have today, right? If there's that change in composition, then that can be meaningful as well. So in particular, I think one beneficiary of fiat money regimes are government borrowers, right? I mean, that is why governments have monopolized the creation of money. Those central banks, they purchase government bonds, essentially giving the government a preferential rate on its borrowing. Maybe that's much harder to do if we're on a Bitcoin standard. And so it might be more difficult for a government to borrow. They might have to borrow at higher rates. How big is that effect? Maybe not that big, but I would be surprised if it's zero, right? And so that's so in that sense, I would be happy to conclude that government borrowing will either fall or become more expensive. But what will happen to total debt, that's less clear, right? Because we may be freeing up some lending that could be absorbed in the private sector. So even when we can identify, or I should say, even if we can identify some subset of borrowing that will decline given this change, it doesn't really tell us what's going to happen to total borrowing. So that further complicates this question, I think.
Yeah, I have a couple of follow-ups to that. So yeah, I think it would be great if a Bitcoin standard discouraged government borrowing, because that would also discourage government spending and a lot of terrible things that we get from government spending. On the other hand, something that Will mentioned earlier is that sometimes we over-attribute the changes that will happen if we switch to a Bitcoin standard. I think we're all on board that we believe the monetary system is really key to the economy, and if we fix the money, we can fix the world, right? But there are some things that are going to continue even if we change the money. I think that I think Bitcoiners tend to underestimate the distortions that are caused by financial regulations and other things that are causing extra borrowing, causing risk in the financial system. A lot of the terrible decisions that banks make are because they're actually encouraged to make bad decisions by bad financial regulations. And so, we have to wonder, are those regulations going to change too? Or is all this going to be occurring in a new financial system that's not regulated in the same way as the TradFi system? If we don't change those bad incentives, or if we end up with these perverse regulations in a DeFi system as well, then a lot of those, extra risk taking, extra borrowing, all those same problems are going to continue, even if we can switch over to a Bitcoin standard. One other thing that I wanted to mention that I actually thought Josh was going to start talking about this earlier, but when we compare the Bitcoin standard to a gold standard, one of the advantages of the gold standard was that it was able to supply new base money as the economy grew, which means as people need more money to spend so that they can do the things that they want of spending and borrowing and whatever in the economy, that there's enough money to satisfy that demand for them. And if Bitcoin is capped and we can't expand the number of Bitcoins, then it can't grow as much, right? And so we're all thinking of this as the deflationary system that's going to be happening. The main effect there is that we can't increase the supply. In some ways that might be good if we're eliminating a lot of extra debt in the system, as we've just been talking about here, but limiting the amount of spending that people can do is potentially bad for the economy, right? And we're familiar with a lot of the problems of inflation, say, the cost of changing your prices, like what economists would call menu costs, and other frictions that it creates. And some of those things also happen when we have deflation. And so even though there are going to be some advantages to potentially a deflationary system, there are some costs as well. I mentioned that I would hope that a credit system would largely mitigate that. But I wonder what Will and Josh think about, thinking about this as a potentially deflationary base money system. Are there other costs or things that we haven't thought of and haven't talked about, that a lot of Bitcoiners might not be aware of?
Well, one thing where I think that our profession gets a bad rap, so maybe we should actually mention this, is that I hear from Bitcoiners all the time, like, why do economists think like inflation is good? And I don't, and I mean, I have some reasons that I could give them for why people say these kinds of things, but I don't think it's generally true that economists do think that it's good. I think there's also this kind of view out there, not just among Bitcoiners, but among the general public, that kind of like the reason we have inflation is because this is what we need to keep the economy going, which is sort of kind of that's kind of like the public's interpretation of Keynesianism or something. But I just, first of all, like that's not the case. So to kind of defend our profession here for a second, is that if you actually look at the literature on optimal monetary policy, the optimal rate of inflation in this literature is overwhelmingly less than or equal to zero. Okay, so if an economist is telling you that inflation is good, you should ask them like why they're ignoring like the overwhelming majority of the literature. That's where you should start. In reality, if you go back to the gold standard, like periods of rapidly rising productivity were actually associated with mild deflation, and it was not costly. These were boom times in like U.S. history. So the idea that sort of like you need inflation for growth, like there's no compelling argument there. But also the idea that deflation is contrary to growth, that whether you have deflation associated with growth is actually just entirely dependent on the monetary regime, right? The reason you had deflation under the gold standard is that productivity in the economy was rising faster than productivity in gold mining, right? Which means that prices for all of this stuff are going to go down in gold terms, and so things are getting cheaper. So I think that that's an aspect. Also, if I can make my favorite controversial claim, what I would like to point out is that if you look at like real GDP in the United States, and you look at the trend in real GDP in the United States from essentially its founding until now, that trend is pretty constant, right? So like the trend growth rate really hasn't changed. And if you think about all of the different policy changes and all of the different regimes that have taken place across that time period, whether we're talking about tax policy, whether we're talking about trade policy, whether we're talking about monetary regimes, we've had a great deal of change. And yet, if you look at economic growth really seems to stick onto this path, which gets back to another thing that we sort of understand from economics, that economic growth is really driven by real factors, right? You've got to have the right institutions and you've got to have the right rules of the game kind of in place for this to happen. But then, growth happens due to like the real factors in the economy, and these policies just kind of create distortions, right? And so I think that we also have to kind of separate that. And so on the one hand, that maybe suggests that moving to a deflationary system isn't necessarily that bad, but also at the same time, it suggests that all of these good things that we expect to happen from hyper-Bitcoinization aren't necessarily going to change that trajectory of the growth rate either, right? And so when we talk about like what's going to change and what's not, I think like it's important to keep all of those different things kind of in perspective as we're kind of thinking about it.
So I only want to defend part of our profession. I don't want to make the full defense that Josh makes. Josh is absolutely right on the literature. I have a short piece, I think it's titled "What's the Right Inflation Rate?" that's summarizing this very cool article by I think it's Anthony Dierks at the Board of Governors. He reviews all of the papers in this optimal inflation literature and concludes, just as Josh says, that in most of those papers, the optimal rate is at or below zero. The most common result is that zero is the optimal rate of inflation. The second is that a slightly negative rate of inflation is optimal. And a distant third is that a positive rate of inflation is optimal. And he identifies exactly 0 papers that support the Fed's 2% inflation target. So that's maybe a separate interesting question there. But the thing I want to say that Josh hasn't said is that although that is the view in the literature, right, for monetary economists, there are a lot of economists who aren't monetary economists. They're not really familiar with this literature. Maybe they're not really familiar with modern macroeconomics, right? They learned macroeconomics 30 or 40 years ago. Their understanding of macroeconomics was whatever was in the undergraduate textbook at the time. And then they went on to do labor economics or behavioral economics or some other field that's not really related to money and financial markets. And so, they're not really up to date on that literature. And so some of those economists say silly things like we need inflation to make the economy function. The second thing I'll add is that we talk about inflation and deflation. The economist George Selgin makes an important distinction, I think, between good inflation and bad inflation, good deflation and bad deflation. So we shouldn't just say, well, is inflation good for the economy or bad for the economy? It depends. Is deflation good for the economy or bad for the economy? It depends. And the postcard version of what Selgin argues is that if that inflation or deflation is driven by the real side of the economy, right? If we experience a pandemic and prices rise because we have less production, right? We might not like that we have less production, but that rise in prices is actually conveying very important information. It's telling us all we need to economize on our consumption of goods and services because there are fewer of them. And there's not really anything we can do to improve our lot in that situation. Yeah, things are worse, but they're as good as they can be given that we've had that natural disaster. Or if we have some productivity growth, right? If we have some productivity growth that causes prices to fall, okay, we're going to experience some deflation. So here we're going to have some growth and lower prices. Nothing to be concerned about there, right? Things are working out well there. So in those cases, we have good inflation or good deflation. But if that change in the purchasing power of money is being driven by a sudden change in the demand to hold money, well, then we could have some problems, some temporary problems, right? If suddenly people want to hold more money and there isn't more money to hold, right, then prices across the economy are going to have to adjust. And they might not adjust very quickly. they might induce people to engage in some underproduction for a period of time until those prices adjust. So in that case, we would have a bad deflation, right? That wouldn't be great. It wouldn't last forever, but it would be better if we could avoid that. Similarly, if we have a sudden burst of inflation that's driven by, say, a sudden expansion in the money supply, or some exogenous change in the money supply, right? This might fool people into engaging in overproduction, right? And so in that case, the overproduction is not going to last forever, but eventually we're going to come to realize that, we were working late, we were working on weekends for money that didn't go as far as we expected it would, and we're going to regret those decisions. And so in that case, we have some bad inflation. So we got to be a little more careful in thinking about, is inflation good? Is inflation bad? Is deflation good? Is deflation bad? We might distinguish between, say, a trend rate of inflation or deflation in an economy that depends on the monetary regime that we're in, and then these potential short-term problems we might get when there's, say, an increase in the demand for money or an increase in the supply of money that are unanticipated.
Those are all really good points that, there's not, it's not black and white. There's not good inflation or bad inflation. It really depends on the situation. So you're right about the market being able to, price things depending on if there was a shock or a pandemic, like you said. So I wanted to go back again. So you guys, before we're talking about the interest rate, nominal and real interest rates. And just kind of thinking, again, in this very theoretical world, wherever we're on this Bitcoin standard and we don't have fiat, how would these rates be set if you were to take out a loan? So say that the MSTR, the MicroStrategy Bank opens or something of its equivalent, and there's no longer 10-year or 30-year treasuries to kind of base these rates off of. So essentially we have a free market setting these rates. What would that look like? And would that be something that maybe this rate could be standardized worldwide, in which case perhaps that would even help or hurt some countries depending on the situation? And if not, then, what would be impacting the rates at a local level, at maybe like a country level or even a state level? A lot of questions, I know.
So as Josh mentioned earlier, it might be the case that if countries are all basing their currency on the Bitcoin standard and making it redeemable for Bitcoin, something like that, then it's, it might be that these countries are still issuing bonds. I don't know if we're talking about a situation where, we don't have that at all. And like we said earlier, I think, like Will said, it potentially could be reducing government borrowing if they're not able to leverage the value of their fiat currency once they're on a Bitcoin standard. And so maybe less. But it could still be the case that, people believe that the U.S. Treasury is the most reliable, risk-free rate. But I think in general, we would probably say that, well, what sets interest rates is productivity and the amount of stuff that we can produce when we borrow, the productive power of investment in factories or, farming or whatever industry we're going to use that money for. That's really what determines the interest rates. And everything else is just an adjustment around the riskiness and the time factor and what we expect to happen with prices in terms of inflation and deflation. But really, it's real productivity that's going to matter for the long run. And so, as both Will and Josh had said, like, as long as we have people that want to do things where they're going to create new stuff, where they're creating value for society, that's really what's going to be setting interest rates, and everything else will be based around that.
Yeah, I mean, even if I think it's hard to imagine if you're not an economist and you grew up in the world that we currently live in. I think it's actually very hard to kind of think about this topic. And one of the reasons it's hard to think about this topic, especially for somebody in the United States, is you just have all of this behavior that's being done, either by like the federal government of the United States or by the Federal Reserve, that has the ability to move these interest rates around, right? So the amount of debt that, the U.S. federal government creates is going to influence interest rates. The policies taken by the Federal Reserve are going to influence interest rates. When you flood the market with liquidity, you shouldn't be surprised when like interest rates are really, really low. But the issue is that growing up in this world, you kind of see interest rates as something that like policymakers are setting. And I'd like to push back on that a little bit because I think that a lot of this actually has to do with market conditions. I think a lot of times policymakers are trying to adjust interest rates at the margin around the market conditions. But also, we just have so many distortions in these markets that it's actually difficult to determine like what the interest rate would be if we eliminated all of these distortions. But it hasn't always been this way, right? So the dollar, I mean, one of the reasons that this system is so difficult to wrap your head around is that there is a single country that produces the global reserve currency. And there is a single country that produces the global reserve asset, which is the US Treasury security. And that's a very, very unique and odd state of affairs, right? So for most of human history, that was not the case, right? Like these countries were holding things like gold or silver or something like that in reserve, and nobody could issue gold or silver. And yeah, around the margins, you could adjust your reserve ratio and you could, print more banknotes, but those banknotes were redeemable for that gold or that silver. And so that sort of limits your ability to do those kinds of things. And so your ability to distort the market was a lot different. And no sort of one single entity had the ability to control the supply of these critical assets that make up our world. And so I think in this current system, it's just actually kind of hard to wrap your head around that if you're not an economist, because you're not used to those kinds of things. As an economist, like this is sort of beaten out of you very, very early on, because we start with a world where none of these things exist, right? We just start with the simplest possible world, and then we think about, well, how are interest rates determined and how is this going on? It's only later on that you're like, well, let's introduce the Federal Reserve, and well, let's introduce like the government debt, and let's see how that influences these kinds of things. But I think, growing up in that world, it's very difficult because we just have all of these distortions and it's not clear. Like a lot of, I mean, you see this in a lot of students, like even students who are very like attuned to what's going on, like they will say things like, well, the Fed sets the interest rate, or like, or things like that. And there's a sense in which that is, there's some truth there, but it's actually, more complicated than that. And it's hard to think about a world it's hard to think about a world very, very different from ours, which is, I mean, I guess what the whole exercise is here today. But I think, but I mean, but I get why people are sort of confused by that.
Yeah, I would just add that this can be difficult for economists too, right? As an example, in 1986, Milton Friedman and Anna Schwartz wrote this paper, "Has Government Any Role in Money?" And if you just think about the timing of that, you might be able to understand why they might write that article then, right? We hadn't been off the gold standard for that long. And so for them, this was still this fiat money world was still relatively new. They had lived in the before and the after. And so these were still very much open questions. Whereas today, right, most economists, they don't remember that pre exiting the gold standard system. Like this is just the world that we know. In some ways, this is a good reason to go back and read older papers in economics, right? Because they were writing in a different monetary regime, and so as a consequence, they're exploring some questions that have fallen out of favor today or aren't of interest to some monetary economists today, right? But what that means is that some of those questions are being overlooked today, right? And even for economists, it's kind of difficult for us to remove ourselves from our current context where these are the monies that we use, and what would it be like if we were using different monies?
Yeah, and I think it's also the history of the pre-Fed gold standard really does provide a great analogy to this, where the government wasn't in charge of the money. I think not a lot of Bitcoiners are aware that we have these great lessons from history. I think it was maybe Nick Carter on Bankless, where one of the hosts said, we never had money without the government until Bitcoin, and Nick was like, well, actually, for most of world history, we were on the gold standard, so we actually have a lot of evidence from that. So I think that is pretty interesting. Again, the base money regime wouldn't act exactly the same as it would on a Bitcoin standard. But if we go back and we look at the credit markets, I think Bitcoiners too have bought into this idea that the gold standard was this terrible period and all these bank failures. And well, it wasn't ideal for sure, but it had a very long-term stable price level, which was great. And we can look at the financial situation and how credit markets worked, how banks worked when they weren't as regulated. And we see that most of the bank failures and most of the problems were caused by either regulations or other government interference in the economy. And some of those we won't be able to get rid of, but we can see, how it's going to function in a situation when the government is not controlling the money supply. If we did go to a totally Bitcoin standard, we can see at least how the financial system worked historically, and maybe we'll end up, again, banks loaning against and holding Bitcoin as reserves. Maybe we'll end up with a mostly DeFi system built on top of Bitcoin. And I hope that, I think that history of how things worked when we didn't have the government, and how financial companies had to protect themselves from problems and too much risk and being ripped off by other banks or financial companies. They were able to find these private market mechanisms in order to do that, and to think more carefully than we do today about the right amount of credit and the ways that they were going to secure that credit, when right now the government is so heavily involved with the banking and financial system that it's just very heavily distorted. And so I think we can, I'd encourage Bitcoiners and people that are interested in how can we build these systems in a good way that's going to be stable without the government controlling it. I think we have a lot of great examples from looking at the pre-Fed history.
Well, and to piggyback on Thomas's point, the other thing too is that we have to really make sure to emphasize is that a lot of these, a lot of what people perceive as costs of previous systems are actually the result of sort of perverse rules or odd regulations or government intervention. And, for example, in the United States, a lot of people, if you ask them what caused the Great Depression, they will say something like, well, it was all the bank failures. And the problem with that argument is that Canada also experienced the Great Depression and they had zero bank failures. And so then you're stuck with this kind of, well, how did we get that way? Well, if you want to understand why the United States had more bank failures, it had so many bank failures and Canada didn't have any. Well, that you can see it by looking at the rules associated with those banks. You can look at the fact that the banks in Canada, were way more flexible in terms of what they could do versus in the United States, where the Federal Reserve was sort of in charge of the money supply and in charge of dealing with these kinds of issues. And so, one thing that we have to not lose sight of is the extent to which government intervention has actually caused a lot of the problems that people think are just inherent in these old systems. And I think that, and this is a key point too, when we compare the gold standard to our current system. There was a great monetary economist named Jörg Nihans, and and he wrote this book, The Theory of Money, in the late 1970s. And so to kind of piggyback on Will's point, he has an entire chapter in there on commodity money. And looking back on it, you think, okay, it's 1979. Why are you writing a chapter on commodity money? Commodity money was over, right? We had moved to a fiat system. Well, because he was looking at it, and you can tell from reading the chapter that he sort of anticipates that we're going to get back to a system like that, the fiat system is probably going to be this temporary thing, because he has this line where he basically says, look, if we write down a theory of fiat money, we can write down a theory of fiat money that actually improves upon the gold standard. And so in theory, it could actually be better. But the point that he makes is but it's not really important whether in theory it's better. It's important whether in practice it's better. And his point that he leaves the reader with is that, well, the gold standard actually passed the market test. People actually chose gold as money, whereas fiat was imposed upon them by the government. And if we look at the history of central banks and we look at the history of fiat money, it's very hard to defend this system. And then another thing that I would kind of say on this point that we haven't mentioned so far that kind of relates to all of these issues is another issue that we really have to think about is like, and I think this is actually like one of the biggest failures of our profession in terms of thinking about the costs associated with inflation is that see, they're getting really excited now because I'm getting into my
Josh is going to get us all canceled in the economics profession.
We're all going to lose our jobs. We're all going to lose our jobs.
Yes.
Is that the issue is like when you think about inflation, like one of the most important things, right, is that the dollar serves as a unit of account, and so whenever we think about units of measurement, right, when we're thinking about units of measurement, it's actually kind of like really important that like an inch is always an inch, right, and so that like we have this standardized unit of measurement, and like we can rely on that. And I think like one of the things that gets lost in a lot of discussions of inflation is that, yeah, if you have like really low rates of inflation or if it, or something like that, like you might not notice this on a day-to-day basis, although you will notice it over longer horizons. But when you have really high rates of inflation, this becomes really salient. And that is the dollar as a unit of measurement actually sort of starts to become worthless. Like you start like it makes it very, very hard to make comparisons because you see something that you don't buy very often and you see the price of it and you think that's ridiculously expensive. But in your head, you're sometimes basing that on like what you used to pay for that thing, but you also might be basing it on what you used to pay for everything else, right? So when you start looking at these things, like the relative price may or may not be different, but you're actually confused about whether it's different because inflation is sort of like deteriorating the value of that unit of measurement, right? And so that unit of measurement becomes less useful. And you see this all the time because like when people just compare prices over very long periods of time, if they just compare something to what something costs in 1975, they just go like, look at how crazy this is, right? And so the funny thing is that you can actually go look at relative prices, and sometimes relative prices aren't really all that different. But if you think about yourself living in that world where things used to cost this and now they cost this, it makes it very, very difficult to make economic calculations, right? And that's a significant cost associated with inflation that we don't that our profession does a really bad job of communicating, because I think actually this is what most people are complaining about when they complain about inflation is it's actually just hard to figure out what you should and shouldn't be buying, right? Because you're trying to figure out, is this price like permanently this price, or is this price a different price, or this price is way more than I used to pay, so maybe I shouldn't buy it this time. But then you look at other right, and so it makes economic calculation really, really difficult, and that's a substantial cost. And you could eliminate that cost completely if you just didn't have inflation. And I think that is I think that is an important point. And I think that the thing about the gold standard, and I guess a Bitcoin standard would be the same thing, is that the thing about the gold standard is that, yeah, things were priced in terms of dollars, but the dollar was associated with a particular quantity of gold. And so to the extent you saw differences in prices, they were reflecting the relative scarcity or abundance relative to gold of that particular good. And so it's tied to some physical reality, right? That like, okay, there's only this amount of gold. And so, this stuff might be in short supply or this stuff might, be in abundance. And the price reflects that. And I think that when you don't have that anchor, it's much, much harder. And so even with Bitcoin, because Bitcoin has a fixed supply, it would have that same sort of it would have that same sort of a characteristic as the gold standard, in the sense that you would be able to compare sort of the relative abundance or scarcity in comparison to Bitcoin for every possible good, which makes these relative price differences and makes this economic calculation easier than when you live in an inflationary world.
And especially right now with Bitcoin numbers going up, it makes all the Bitcoiners feel like, hey, prices are going down. Look how great this is, right?
Right. I
was
love
just
the
gonna say
people.
like yeah.
I love the
Go ahead.
people who will post like everybody will be talking about eggs, like oh egg prices are way up, and then somebody will do the chart of like eggs priced in Bitcoin, and they're like I don't know, looks down to me. I do that's a great meme.
In the house as well, how much the cost of a house, it's gone down so substantially. Yeah, it's very helpful. Okay, that's probably a great place to wrap. We're right about at time. So this has been an excellent discussion, and I would love to have a round two at some point and maybe go into like tangentially related topics if everybody is down. So any last closing thoughts from anybody that they maybe we didn't touch upon?
It's okay to hate economists sometimes. Just don't hate all economists all the time, right? There's this sentiment that like economists don't know anything about Bitcoin, and economists have never thought about competing monetary systems. And all right, like I'm an economist, Josh is an economist, Thomas is an economist, right? We think about these things quite a bit. We share those frustrations with other economists who don't think much about those things. But it's not an empty set here. We think quite a bit about these ideas, and certainly in the history of economic thought, lots of other great economists have thought about competing currencies and alternative monetary systems. There is a lot to learn from those economists. So don't be dissuaded just because some economists say silly things.
Well, I love economists and I love talking to economists. So maybe in my next life I can actually go and, get a PhD in economics, but not in this one. So okay, well, with that, thank you so much, everybody. It's been a great discussion, and I'm looking forward to future conversations as well.
Take care.
Yeah, thanks a lot.
Thank you, guys. Bye.